Good morning, good afternoon, good evening, wherever you are. This is Murad Osran, and I'm happy to introduce you to Brett Cupta to talk about how to prepare for Series A. This is one of the biggest dilemmas of the being. Sorry about that. My alarm saying that I should be ready uh, for the seminar. Well, Brett is a very interesting speaker, and I'm looking forward to hear his details. He's a co-founder of several startups. He's managed to raise over $180 million for Series A and subsequent fundraising activities in the startups. And one of the important things about it that Brett is going to talk, he's going to talk about what has changed in 2025. How can we make sure that things that we know we've done, etc., is going to be impacted in 2025 and 2026, and what to look for in the next 6 months to a year from startup perspective, and how to prepare for the discussions with the investors, because investors changes constantly with the political and economical situations. So Brett is a co-founder of Sitetracker and Blockify, and he's actively working in the Sitetracker at the moment. And he's coming from a corporate background with Deloitte and etc. And he's based out of the Silicon Valley, Palo Alto, and I'm looking forward to hear his experiences and his actual views and experiences that he had, plus what he hears in the Palo Alto, Silicon Valley about the investing and what to be prepared in a Series A fundraising for your startup. Welcome, Brett. I think we might be having a little bit of a challenge. Hi, Brett. Sorry, Brett, I can't hear you at the moment, and I cannot see you as well. Oh, here you are. You're back.
There we go. I'm seeing that it's just a blank screen for me right now. Hopefully that will switch. But you guys don't have to see me to see my presentation. So maybe I'll try to switch over to that and see if we can get going here. All right. Can you guys see the presentation? Looks like you can. Great.
No, not at the moment.
Oh, not at the moment?
No, we cannot see. We can hear you, but we cannot see the presentation.
Try one more time with resharing this. I will turn on and off my camera to see if that solves the problem.
I can see you now as a person. It's nice seeing you again, Brett.
Yeah, it's good to see you. Okay, well, and you guys are able to see my screen or not able to see my screen?
Not yet. We can see you, but we cannot see your screen. There's always a demo glitch somewhere, unfortunately. If you want to see something perfect, is demo mother of all demos on YouTube. In 1960s, how people actually made the demo that really shaped Silicon Valley, and that way it's going to be interesting one. And it is one of those things that really shaped the IT industry. So there's always a challenge, but in this demo that you see in 1960s with the black and white videos is in Palo Alto. They are demonstrating things like video conferencing, sharing screens, etc. And they've been very successful. And that's one of the very interesting computer demos that I watched. Yes, I can see the Brett live. Unfortunately, I cannot see the presentation.
Okay, well, we'll go perfect. All right, there
All right,
we
I
go.
can see it.
All right, well, thank you again. Sorry for some of the technical difficulties that we had here. I will not be doing a reintroduction of myself. Just one thing I would definitely want to point out today as we get and kind of dive into the topic is just part of my personality is kind of always growth focused, always room for improvement. And when we were coming out with what this session could be and what I could talk about as preparing for a Series A and really focusing in on just a portion of it because it's a big topic, I did want to focus on different items that you'd be able to do in the short term and not have to spend a lot of time trying to fix or change that's going to take you a year out or so from your investment. So what we're going to talk about today is not the side of a Series A of we have to create a Series A business. We're going to be discussing optimizations to an existing business that has all the characteristics that they are capable of getting a Series A. So the company's vision, you're able to get the VC to understand that. You will see the problem and solution. You're hitting the mark there. The timing of when your product's going to be coming to market's good. Go-to-market strategy's fine. Those are the things that would take a long time and potentially even a pivot of your company to correct. So we're going to assume that's all acceptable marks. You have that there. And we're going to focus on that optimization and that turning the dial of how do we just get that over the line to get your Series A investment. We also won't be focusing on other, I would say, big rock items, the pitch decks and data rooms you need, finding the right VCs or valuing your company. Again, we're going to try to focus on what you can do, start doing today if you're going for your Series A to make it more likely that you get there. So whenever you're speaking or trying to convince anyone of anything, it is very advantageous that you understand where their mindset is. And the good news is VCs have a similar outcome, regardless if they're niche or how different they are. If they focus on one industry or if they make one level of bets up to a certain dollar amount, they're all looking for the best return on their investment. And the way they evaluate a company is also going to be very similar. They're going to be looking to balance the risk and reward that they'll be getting to maximize that return on investment. And in some cases, it's not that they're normally trying to change this, but they're going to be looking at the duration and timeline of which the business will be exiting. Now, as someone that owns and leads a business, there's one thing that I think you can impact the most without making those big macro changes is reducing the risk. So that's what we're going to focus most of our time on today is how do we take the business we already have and de-risk it. Check some of those boxes, make the VC have a lot of those unknowns become knowns. We will talk a little bit about increasing the reward that the VC would get at the end, but that's more the perception and being able to describe that well. So what are some common risks that VCs will see in your business? They will see risks with the team. They'll see risks with the timing of where it's coming to market. There'll be the investment size they have to give out, execution, market. There is going to be another set of 20 items that are going to be on a risk list for a venture capitalist. They do focus more on some than others in Series A versus later rounds. But we're going to talk about is how do we mitigate the ones that we can, again, in the short term without making these macro changes to your business. So there's 3 different sections we're going to talk about. First, we're going to talk about how do you provide clarity about your business. We're going to talk about how you prove that you're capable of handling the funds when you receive them. And then we're going to get into somewhat of a disjointed topic to the initial risk mitigation. This is more about appropriately talking about your potential and reward. is how you display the potential of your business and stay grounded in being realistic. And if you can do these three things, and again, you already have a business that's in the realm of getting your Series A, you can get it. So let's talk about some of those strategies. So first, clarity. Okay, so I divided clarity into two buckets. The first bucket being your corporate metrics and KPIs. You should have these. I hope you have these. But these are what's going to explain everything about the health of your business through numbers. And then you have the other side of providing clarity is when you're actually asking for something. I've seen and I've coached other founders, actually a little bit more recently, is that when people are asking for something, they're not giving you a complete ask. So we'll go into that as well. But let's start with the corporate metrics and KPIs. Now, you're trying to convince the VC that you're working with to invest in you. And you know absolutely everything about your company. You've founded it. You are a leader in that company, but the VC is learning. So these KPIs are three things to them and to you. They're the cliff notes that venture capitalist is looking at to understand your business that you've built and are passionate about. What they can be is they can also be a confidence booster. The way that you present them and how they're shown to the VC will actually speak volumes about how prepared you are as a business to scale. And they also can unlock some VC assistance as well. If they see something that's a problem they've solved before because it's displayed in the KPIs, they will still be okay with that. It's not as scary if they know that that's a problem that's been solved. So you can unlock assistance from certain VCs that specialize in helping companies in certain ways. So the numbers certainly matter, but again, we can't change those instantly and snap our fingers and have 50% better gross margins. But what you can change, and you can change immediately, is how they're presented. So when I look at KPIs, they're not all equal in the amount of information they provide you. And this has nothing to do with the KPI you're reporting on. There's three different types of KPIs. So you have the first one, which I call a point in time KPI. This is table stakes. This is the most basic of KPIs. It's better than nothing at all, but it's telling you one piece of information. It is saying this is where we are today. There's no context and there's no vision. Now, the next one that you're getting into is a trending KPI. You can already see that this is a lot better. I think this is the biggest step up, getting to trending. And if you have mainly trending KPIs, that's a huge help because they provide a history lesson. They provide that context that has someone understand where your business has been. And then the final and the best one, most people probably guessed it, is trending with forecasts, because this is a complete story. You're saying, here's the history, here's where we came from, here's all the context, this is where we are today, and this is potentially with or without investment where we'll be going in the future. So we definitely want to lean as much toward trending with forecasts to get your venture capitalist that's evaluating you up to speed as quick as possible. So quick example here, a point in time metric for customer acquisitions or logos that you'll be winning. You have 10 out of 22. So that's a point in time with a very short-term forecast. So it's really just telling them, yeah, if we're halfway through the month, they're on track for that quarter. And they are halfway through the quarter, they're on track. And they expect to get 22 and they have 10. Trending helps you tell a story. So when someone asks a question, a VC asks a question about this graph, you get to tell them that you had an issue between 23 and 24, where you had not successfully scaled your demand. You instilled a new leader, you increased your team size by X amount of percent to get back on track, and you did in 2025. You just got to communicate that you were able to solve a problem, you were looking at your metrics, and you made that change. And that does provide a lot of confidence. And the best case scenario, when you have your forecast, you get to not only talk about maybe a problem that you resolved or where you were doing well in your history, you also get to talk about the future and say, with your investment, you're able to scale here. So again, that is the best version of these. Now, I am not going to go over all the KPIs that you can report on for your business. That's dependent on industry. That's dependent on the type of business that you have. I toss them up here just so people get an idea and hopefully can level set on those. But I did want to go over, you should have some KPIs that might not be common, but highlight where your business strength is. In one of my past companies, Sitetracker, we tracked a metric that showed how great we were at growing accounts. And that was months to double the initial contract value. And that was really powerful. And it's not something that I would probably see in every single deck that's being presented, but it was a strength of our business and we wanted to highlight that. So in addition to reformatting and making sure that your KPIs are the trending at least and trending with forecast, it'd be very good to also have some unique KPIs as you communicate this. Okay, next part of providing clarity, and again, we won't go into as much detail here, is having that complete ask. Whenever you're asking somebody for something, how you do it really does matter. If the ask is disorganized, that reduces confidence. If it's unrealistic, it reduces confidence. If it is just overall kind of a scattered ask and doesn't contain every piece, they don't think that you're going to have what it takes. So there are going to be 3 components to an ask. You're going to have what you need. And again, this is obvious, but I'm hoping the color below it still provides a lot of value to people. What you need or what you're asking for is going to be the first part, what they're going to get out of that, and then how it's going to be used. And that's going to be really the meat. But when you start saying what you need, just be crystal clear. It is a number that you need. It is the size of the round. It is the amount of the round that you want that VC to be taking part of. I would give a couple kind of tips here. Do not ask for too little. Do not take your runway and like assume you're going to raise a Series B right at the end. And also, if you do get a little bit more and someone wants more investment in your company and they want to give you more for that, have an opinion on what you do with that money. Now, the second part of what they get, it's going to have the 2 components there. You're going to have what they get immediately with his ownership percentage, which is just a calculation. But more importantly, you're going to have what they get in the future. And that's going to be based on your expected growth. And that's going to go into how you communicate your top end potentials, which we'll get to in the 3rd section. But one thing that I was actually talking with my brother with last night, who's a VC, he says a lot of times when they're going into Series A pitches, the person talking to him sounds like the Series A is going to be their last funding round. And that's highly unlikely. So as you talk about your growth and your vision, you have to have a blended story of where you'll get to this investment with this investment. Where you get with this investment is going to need to be a place where you can get another round of investments, potentially with fresh investors. And then you also want to make sure you're telling that big, broad story of where the company's going to get that big return. So just make sure that you're not thinking the Series A at the end of this is your stopping point. And then the last part is kind of the meat. It's how this money is going to be used. And we'll get into how it's going to be used kind of again in that last section, but you really want to spend most of your time here. The how is the important part. So make sure that you are taking this how, it's focused around a digestible outcome of we are going to expand internationally into these markets, and everything rallies around that simple idea, and talk about the areas you need to invest. Like show your expertise through your talk track. Okay, second main section here, capability. So if you're going to say that you're capable, and hopefully you are, you're going to want to operate in a way that a venture capitalist has comfort. And that's the way of mature businesses. Businesses operate in a certain way for a reason, at least successful ones do. You don't have to reinvent the wheel with everything that you do. And the more you operate like that mature business, the more confidence a venture capital firm is going to have in investing in you. So there's 3 things that you should be doing or at least transitioning to do as you're getting out of this scrappy startup stage into a Series A investable business. And they are cadences, which are just reoccurring meetings or checkpoints, playbooks, which each team should have, and it's just an operational manual for how that team runs. Has more benefit, and we'll go into what those benefits are, than kind of just being an instruction manual. And then having a mature org chart. And that doesn't mean having an org chart that just exists. It's something that can scale. It is easily understood, and an org chart that you can have an open discussion with the venture capital team, because that's where you're probably going to be spending your money. So these three things are vehicles that will help you scale, because you're promising that you're going to scale your business. Scaling is going to require change, and then change creating the risk. Having these three things and executing on them right will decrease that risk, so that your VC believes that you can grow to where you should be growing. Okay, cadences. So I think most people would understand what cadences are. These are your reoccurring meetings, or these are frameworks such as OKRs that are going to help you stay aligned throughout the time of your company. So I highly suggest OKRs. I would say definitely, if you're a leader, read about OKRs and make sure you're doing them the right way. I see a lot of companies misuse OKRs or use them differently. It's not as that agent of change and focus. But you do have those as kind of those cadences and checkpoints. But you want to make sure that these are cadences that you're using to keep these trains running on time. I'll go into the next slide on just what I would say are common cadences and frequencies for a Series A company. But again, every business is different. If a cadence is not working, like a certain type of meeting, and you're not getting value out of it, or it feels like it's being done too often, it is the time to change it or eliminate them. So make sure that you are not wasting your company's time. Cadences should not be a waste of time. You should be able to use these to help your business stay aligned and make sure that you're able to implement the changes that you are suggesting to get to the outcome and the reward of your Series A. So I won't read through all of these. I think we'll have this deck as a takeaway so you can look through these. But you can see I've divided them into a few different sections of your corporate meetings and your leadership meetings. Each team should have their own individual bucket. And then if this is a software business, go-to-market and product are going to have these unique meetings as well. Okay, playbooks, the instruction manuals to create those predictable and repeatable outcomes. So playbooks are extremely important. There's going to be a few things that I wanted to point out of like how playbooks can really help in this scaling stage. One, playbooks, they are great onboarding tools. Playbooks are also amazing for aligning cross team initiatives. So you're going to have a playbook that can help you understand what another group's doing without having to go through a full onboarding process, particularly if that person hasn't worked in that division before. And finally, they're a record of change. They're actually saying, okay, we need to do this to get our Series A. We put it in the playbook. We know there's a record. We know people are looking at it. And we know that you're going to be able to use that as the source of truth. Now, a few tips on playbooks: put them all in the same tooling. Don't do different tools. It's going to make things more confusing. It's hard to get everybody to use the same tool, but you should have all your playbooks in the same spot. And the second is avoiding the it's in the playbook answer. Leaders are going to put a lot of focus into these playbooks, but you need to have that patience to explain it again and again as other teams are looking at it. Nobody wants to really go back to the documentation each time. So be patient, go ahead and explain it again. So playbooks might have a few different formats and versions and pieces of information in there, but I figured I would write some down that I thought were important parts of the playbook. Again, I won't read through these, but playbooks, again, should have everything that you're going to do. If you got to go take a 2-week vacation, someone should be able to read your playbook, step in, and keep the team running on time. Okay, a mature org chart. So this is the map of your company's investment. Most of your Series A is most likely going to be scaling of the company, and that means adding additional employees. So if you don't have an org chart, how can it grow? If you don't have a division of labor, where can you focus your investment? And kind of one that's not on here, if you're using kind of strange narratives or have a strange structure within your org chart, how can a company, that VC company, help you grow into a company that can get the growth that they're expecting from their investment if they're not really understanding why and how you're structured? So this is a call for 2 different things within the org chart that you have. Use standard terminology, use standards, groupings, and divisions, and have those alignments within your org chart. And make sure that you are having this org chart be a living document, a basis for discussion of the investment. In order to do that, please pick a tool. Don't just keep hacking a generic tool or trying to do this on a tool that's not meant for org charts. It wastes a lot of time. There are going to be a lot of changes and revisions to this. Spend the limited amount of money on a tool to actually work on it. Okay, so how are we in just wrapping this up for proving the capability? So cadences, they're proving that your company has structure. You're not a scrappy startup anymore. You are turning into a mature company that can grow and is ready for the scale and change. And those cadences help keep everybody aligned and moving in the right direction. Team playbooks are proof that each team has their responsibilities outlined and the processes to achieve them, and can be used as a living document to implement change in a structured way. And then finally, the mature org chart is your way to strategically grow. It highlights your areas of investment with the Series A that you're going to be getting, and it invites discussion with them. So you can use these 3 items to display your readiness for change and scale. Okay, potential. All right, so this is how you communicate your outcome. So I put 2 examples here, and I already know the answer to the question, I think, from everybody here, is if someone asks you what the weather is going to be this coming Monday or next Monday, if you say 74 degrees, most people aren't going to believe you. If you say between 70 and 82, most people are going to be like, okay, probably, but that's not really helping me plan. But if you say something more like it's going to be between 72 and 77 based on hyper-local historical data, that's a really good answer. I feel confident in what that person said. They're, 1, saying that this is based on data, and they're 2, giving me a range that can provide some value. Now, if you change that to a relevant example, what will your revenue be in 3 years with this investment? Again, saying something singular, 1 number, it just opens up to that's probably not right. That's how humans think. But if you're able to give this range, you're able to do a few things, which we'll talk about on a future slide. But you're able to talk about the not even the moonshot, but the high end, like show the potential of what it is without really seeming unrealistic. And you can also de-risk some of the downside by having a lower bound. Now, I will not go through every piece on this slide here. This is more ChatGPT. I went in there. I was like, I know there's psychological principles of why people think in ranges. And this is actually the output of that. There is just under 10 different psychological principles that all explain why humans think of uncertainty as a range. Therefore, if you give a human just a regular number, they are going to look at it and they are instantly going to be skeptical of it. If you give them a range, they're going to accept it more naturally through how they process information. So ranges aren't just a great idea. This is any time that there's something that's uncertain, which is a forecast. Forecasts are always uncertain. it's very important to try to make sure that you ground it in something that the other person that you're talking to is going to understand. And that's a range. And the range, particularly in forecasts, most importantly, can use the bear base bull case. This is representing your downside, which is the bear case, your expected, which is the bull or the base case, and the upside, which is the bull case. So this has a really tangible benefit, and I always highly encourage everybody to explain key forecasts in this way. This doesn't have to be all your KPIs, but key forecasts, especially when you're trying to convince something of something, is to have your bear, base, and bull case. And if you want a bonus, you can also still have a lofty target, which is a number that's somewhere between the bear and the bull, but above the base. So tangible benefits, you can paint a picture of this ideal case without being a dreamer or unrealistic. You can paint the picture of a downside that's normally not too scary. And you're less likely to have egg on your face by picking a single number, which you probably won't hit. You might get close, but you're not going to hit. So a few tips here: do not oversize that range, or you will lose confidence in you're just saying, yeah, it'll be between two numbers that it obviously has to be between. And when you kind of show downside, make sure that's going to put a question in the venture capitalist's head. What lever are you going to pull to get out of the bear case? Like, be thoughtful about why you came up with the lower bound. And if it happens, what are you going to do about it to get back on track? Okay, so let's wrap this up, and hopefully we can get into some audience questions here. What we talked about today was 3 different pieces of a Series A and how to make those small tweaks to your business to do it. The first one being clarity of just the pure definition. If it's an unknown, it's risky in a pessimistic mind, and it's always assumed to be the worst case scenario. And that's what most VCs are. They have a mindset to see and find the problems. So if you provide clarity to it, you limit the number of unknowns, you open discussion, you paint a clear picture of your business, it's only going to be good for you. The second thing is to prove that you're capable. Poor execution is the most common reason a startup will fail. So if you can prove that you're capable and you can de-risk that by having these cadences, playbooks, and org charts that a VC can look at, they're going to have a better opinion of you that, yeah, you are going to avoid those pitfalls. And even if you do, and you have a problem, you have all of this structure, mature business structure around you that you can still succeed. And then the final part, and it's displaying your potential. It's really hard to not be overexcited as someone that has started a business and see that amazing moonshot, if everything goes right, and just convincing yourself that you can get there. And that's great. But you do not want to paint that picture as you are dreaming. And you can do this with bear, base, and bull, because your bull case is just an option. It's the top end that you think it can get to within a realistic way. So you can still paint that picture. You can feel good that you're not leaving anything on the table, but you're able to ground it with both. Yeah, there could be downsides, and I'm aware of it. And this is really the most likely based on the data that we have. So if you use these 3 risk mitigation categories, I would say you are closest to being an investable business. So, all right.
Thank you, Brett. This was a great summary and great ways to look at it and understand what being preparation for Series A means. And that is one of the important things that I think you said, is that you're no longer a scrappy startup. And that mentality is difficult for startup people to change from being a startup to an organization where it's got stable, it has a cadence, it has organization, etc. So while we are waiting for the questions to come up, what is your experience and guidance for changing that attitude from crazy 24 hours or 20 hours a day startup attitude towards a much more structured and cadence?
Yeah. So that's a very great question. It's kind of hard because, especially when I was at the early stages in the companies that I founded, a lot of the reason that you found them is to go against what's being done today. It's you find this area that you think you can do better, and that's by being unique. It's really fun to work on a lot of things, and the best early employees in your startup are going to be the people that can work across divisions. Like those are all really important characteristics. But in order to make that change is to create that realization in your company and talk about, we are having a chance that most startups really actually fail before, to get from this scrappy startup to a mature business. And it's a lever that we must pull. It's not an option. It's still going to be your company. Make sure people understand that it's still going to have the DNA. Maybe do an exercise early on of having your founding principles and your core values and say, these don't change. We're not changing the company. We're growing up as a business. And if you can get that across to all the people that work for you and with you, you're going to have success in being able to, again, turn that corner, become Series A investable.
So there's a couple of questions on the chat. So when investor asks how we plan to use the funds, how detailed should that breakdown be? And is high level allocation enough, or do they expect a clear plan by function and milestone?
Yeah, I mean, I think that question's a lot about the when and the ask, because it's kind of both. So within the initial presentations to your investors, you want to still hook them. They are still the fish out there that you're trying to hook. And if you get into the minutia too early, you're going to lose them, right? So how you're going to spend the money needs to be around a core principle. A principle should be simple and easy for anybody to get there. If you're in a crowded bar talking to somebody, they should understand what they're investing in. So you don't get into the detail in the actual beginning of it. You say, we're going to be using this money to open a new office here to expand our TAM to do XYZ. It should be that simple. Now, if you do hook them, then you better have every bit of support about why you're using the money in that way, how you're going to spend that money, and you get down to that very clear expected plan. The other thing I would like to say there is, if you're an experienced entrepreneur, you're going to get a little bit of a pass on some of the minutia and detail, especially on these early rounds. But if you're not, you need to have everything buttoned up in a row without question if they ask a very specific answer. If you cannot answer that, that's a lack of confidence. So I would say your communication should be high level to start. Make sure you hook the fish and you're not talking about things that you never even should have gotten to that point. But once you do, you better be able to back it up. So hopefully that answers the question.
Yeah, that answers the question. And the next one, how we plan to use the funds, how detailed, about the showing the bear, base and bull cases in our deck. I want to project confidence without losing credibility, how to be able to show those cases.
Yeah, so I think when you're in the presentation for what it is, the natural bear, bull, and base case on a slide is going to be something that's digestible, right? So you don't have to worry about that first slide making you be that dreamer and being too optimistic. As I said, you don't want to have the range too great, because how can anything change a business that big? So the range needs to stay tight. So I think that first slide, it almost doesn't matter what you're going to be putting up there. What I would say is the backing to it is each different bar. So you have three, you have the bear, the bull, and the base. All of those would actually be independent calculations that have their own independent backing. So if we're talking about the bull case and just being very optimistic, why are you optimistic? What numbers, what math did you do to get there? And it's the same thing with each of the different ones. So it's having those three cases, keeping the range tight, but each of the three cases has its own set of supporting information and changes to assumptions that get you to that final number that you're promising.
just maybe from my experience, just to say that the bear case doesn't mean that, hey, we are quitting and we are drop everything and leave. That's not the bear case we're talking about, you know.
Yeah, for sure. Yeah, I mean, I think I might have put it in the slide, but you can say this is the lowest we've performed in the last 3 years from our productivity values. That's our bear case. We have another one of those bad quarters. You don't have to go below that there's a global meltdown of the economy. Yeah, that's always going to be there, but that shouldn't be calculated into your bear case for sure.
All right. Brett, thank you very much for the insights, and I'm looking forward to the recording. And thank you very much for the questions, the audience. And I appreciate the insights and what are they looking at the moment in the investment market is very important for startups. And looking forward to catching up with you soon again.
Sounds good. All right. Thank you, guys.
Bye, everyone. Have a nice day. Thank you very much, Glorium Technology, for providing this opportunity, and looking forward to be part of and listening to your webinars and discussions.